Can 2015's weakest apartment rent growth performer across the nation gain some momentum in 2016? That's our topic for today's Apartment Market Dynamics from MPF Research, and the market we're talking about is Little Rock. I'm Greg Willett. Cameron McIntosh is here as well. Cameron, we say it is the weakest rent growth performer across the country. Give us some perspective on how far that really is under the norm.
Well, Greg, most of the nation's top 100 metros have posted pretty impressive rent growth this year, but there are some laggers. For example, growth under 3% accounts for about a quarter of that total sample. Additionally, there's about 10 markets with growth under 2%, and there's an additional 2 markets that are coming in under 1%. Those 2 bottom-performing markets, Greg, include McAllen-Brownsville area of Texas, where growth came in at just 0.8% this year. And it came in for Little Rock, which was just positive at 0.3%.
So one of the challenges of getting any rent growth going in Little Rock is that the occupancy numbers are pretty bad too. So let's start looking at those. The current rate is just 93.3%. That's 290 basis points under the U.S. average of 96.2%.
While occupancy is weak, it is important to consider the metro's outlook, which is getting better. Occupancy of 93.3% is up 200 bips on an annual basis and up 320 bips from the bottom point that we saw in the late 2013. Little Rock is adding jobs at a pace of about 2% in 2015. That's up from 1% in 2014 and from job loss seen in 2013.
So some job additions, a little bit stronger demand, and at the same time, we're actually slowing down the completion numbers. After annual completions here ran around the 1,500 unit mark for a couple years, additions were held to just 466 units during the initial 3 quarters of 2015.
And going ahead, near-term completions is still going to be limited. Of identified ongoing construction, there are 3 projects totaling 164 units. Construction activity that small leads to an occupancy forecast of about 100 to 150 basis points going into 2016. That will take that annual rate up to about 94%, which would be the first time since 2008, Greg.
So improving occupancy, and that should mean that rent growth is going to get a little bit better as well. Our base case scenario calls for rent growth in 2016 around the 2.5% mark. It wouldn't be surprising if we got actually a little bit better than that. The last time this market had truly healthy occupancy, the rent growth number was sustained right around 3%.
What to really watch for in Little Rock in 2016 is going to be a dramatic upturn in Class B rent growth. A year from now, occupancy should be essentially full, coming in about the 95% mark. The price differential for Class A and Class B segment is a whopping 29%. That leaves ample room in the Class B segment for price gain once occupancy stabilizes on some firmer ground, Greg.
So that's our take on the Little Rock apartment market as we look into 2016. Not a top-tier performer, and in fact, probably a little bit below the national norm, but a big improvement from what we saw in 2015. This one won't be in last place again in 2016. This has been Apartment Market Dynamics from MPF Research. I'm Greg Willett. He's Cameron McIntosh. Thanks for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.